Recipes for technical trading success in Cook's Kitchen.
Is the correction over? I think not. Last week I asked, are we in a bear market? And I said, no, we're not in a bear market yet. We could be. But until the economy goes into recession, we're probably not going to have a bear market. But I think the correction gets deeper, and that's because of the earnings recession. I think we go to new lows. Let's take a look at some of the data. This is from our Director of Research, Shiraz Mian. He has plotted the quarterly earnings growth. He tracks it all the time. And what do you see? You see an earnings recession, right? Here's Q2 of 2015, minus 2.1%. Q3, minus 2.6%. Right now, Q4 is stacking up to almost minus 6% year-over-year earnings growth. And what do the estimates look like for Q1? They look like they're going to come in about minus 5%. And you come out to Q2, I've seen this negative at some point. It's hanging on to 0% growth. So there you have it. There's your earnings recession, getting deeper, getting longer, extending to 3, possibly 4 quarters. And the top line is no better. I believe the top line may be pushing 3 or 4 quarters of negative growth as well. So this is why in October I said we still needed a valuation reset, and I was bearish on the earnings recession is my top catalyst for lower prices. Now let's look at another view. This is from Keith McCullough at Hedgeye, and he did a little study here going back to 1985. When you have 2 consecutive quarters of declining corporate profits, an earnings recession basically, it hasn't always signaled an economic recession, but it's always signaled a stock market crash in the subsequent year. Now by crash, I believe he means down 20%. Right now, the correction that we're in, if we want to just go from the all-time highs of 2134 on the S&P to 1804 on the S&P, that's 15.5%. We're back above 1900 right now. Things seem fine, right? But I do not think that the market has fully priced in what's happening to earnings. That makes the market expensive. Here was a chart I showed you last week where on January 28th, where I am plotting to buy lower because of the valuation reset that I think is going on. And, you know, based on where 2016 estimates are and what multiple you want to pay for them. So to me, this is where the market gets attractive again. Down here, 1740, I've marked it, happens to be the February 2014 lows. It would also coincide with 14.5 times $1.20 EPS. I'm going to show you some, where the market's at in terms of investment bank strategists, what they're projecting for 2016 and how they've changed. But I just wanted to review. This is what we talked about last week. This is what I've always done when we go into correction, is I determine where is not only the technical support, but where's the fundamental support? Where will money managers come in and buy? In an extreme case, if estimates continue to drop for 2016 down to $115 aggregate for the S&P, and if fund managers race in to buy at 14 times, they're probably buying before that, but I think that creates a low, and that's 1,600 in the S&P. That would also coincide with what all the technical bears are looking for, is a big technical reset down to the breakout levels, 1575, 1,600 on the S&P. Okay, so welcome to the great valuation reset. That's what I say is going on now. I just want to run through some of the bullets here. David Kostin of Goldman Sachs was the best fundamental forecaster of 2015. He was the guy, if you remember, I've been talking about him since January of 2015, was, very subdued, cautious to almost bearish, lowering his EPS estimates and his price target for 2015. And then in the middle of 2015, he brought 2016 down to $120, way below consensus. Turns out he was right. Lots of strategists are now following him this month. Before I walked in here, I just got a note that the UBS chief equity strategist just took his 2016 estimate down from 126, which was about where consensus was, to 119 for this year. So these guys are playing catch up to Costin at Goldman Sachs. All right. So, and just a couple weeks ago in early January, Costin lowered to 117 based on what's going on in the oil bear market. Whoops. So the Wall Street consensus is still closer to 125. I mentioned UBS, finally capitulating. The other day I saw a fund manager from JP Morgan Funds, Anastasia Amoroso, and she summed it up this way. She said, hey, the market is at 120 to 123 bucks, kind of the middle of between Costin and the people who are still high in the consensus near 125. And, do you want to pay 15 to 16 times? Well, if you do, 15 and a half times 121.50 is S&P 1883. Now, the question you have to ask yourself, since we're right near there, is that make the market cheap, or is it fairly valued, or is it expensive? I don't think it's cheap. I don't think 15 and a half times in a declining earnings environment, in an earnings recession, when those estimates are still in jeopardy, I don't think that's cheap. Is it fair? Maybe it's fair, but if the risk is that the estimates keep coming down, then you don't pay 15 and a half times for falling forward estimates. So I say that the market is somewhat dear here, somewhat expensive. And that's all I really wanted to cover with you today, was just to make the point that the earnings recession, I believe, will create new lows for this stock market, probably in February or March, and you want to be prepared for that. You want to be prepared as a buyer as long as there's no economic recession. And who cares about the Fed? The Fed is going to, they're back on their heels. They don't want to hike 4 times this year. And they certainly don't want to be backed into doing any more easing and admit that the economy is in that kind of bad shape. So really right now, focus on the earnings that you're seeing and the earnings estimates, and look for better buying opportunities lower. I'm Kevin Cook. Thanks for joining me in the kitchen.